Hasn't gone. It's still saying pre-live on the screen,
Right.
Sharon.
We're
There we go.
live now.
Well, good morning, everyone. Apologies for the delay in getting this webinar started. First time we've had the proverbial technological difficulties in 3.5 years of running the Rethink webinar series. I think this is episode number 18 or 19. So apologies for that delay. Mark and I contemplated pretending as if we'd still been talking for the last 30 minutes and we're halfway through the presentation, and see how you all reacted to that. But thank you for bearing with us, and thank you for joining at this new time. My name's Ian Craig. I'm BDO's Eye on Tax for obvious reasons. And I'm joined today by my great friend and partner in our Christchurch office, Mark Lauder. And hi, Mark. And today we've got quite a lot to get through. If my screen will let me change pages. Sharon, that's not, I might give you control back and you can see if you change it. If there's one technological hit, it'll go to the next one. Right, okay, so today we're going to go through a few things. Look, Mark is going to go through essentially the essence of a discussion document that came out from the Inland Revenue and officials around protecting 39% tax rate, and in particular looking at some measures that would have a significant impact when you look to sell your family company. I'll deal with trust compliance and some of the new disclosure rules that are going to impact the 2022 tax return. And follow on from that, we'll look at sort of the increasing amount of online share trading, which will also dovetail nicely into cryptocurrency. We will have a quick look at the forthcoming budget. We don't expect too much to happen in terms of tax in this year, being the middle year before election time. Any tax changes are likely to be, the powder will be kept dry and delivered, we think, in next year's budget. And we'll have time for questions as well. The idea with questions is please put them up in the chat box facility and they'll be sent through to us, and we'll try and do our best to answer those questions. This session will be recorded and available on our website after. Over to you, Mark.
Ian, just request, while I wait for control, I'll just reiterate a hearty thanks to all of you hanging in there while we corrected the technical, and especially to Doug out there. So you know who you are. Thank you, Doug. Right. Okay, look, I can't get the slide to go, but I know what it is. Here we go, tax avoidance. So we're just going to run through a few. All right, we're going to run through a few things. Sharon, can you just, will it hold here? The discussion document that Ian just referred to, which came out last month, submissions closed on the 29th of April, didn't give us a great deal of time to think matters through, because obviously it's end of year, and given with the COVID extension to the 31st of May, people still working through their year-end matters. But anyway, the discussion document was talking around dividend integrity, the personal services attribution rules, 39% rate, protecting that, and the need for taxpayers to hold better records. So I'll go straight into the first one. Now, there's not a great deal of sexiness in tax, but this particular topic is dividend stripping, which is a wonderful name, but fundamentally there may be more of a tendency to strip when the greater the gulf there is between the corporate tax rate and the marginal tax rate of the shareholder. And we very much experienced that around the 31 March time when the 39% rate came in. We saw that there was a flurry of dividends being paid, because people didn't want to pay as much of a top up, perhaps. So we have seen that dividends spiked. So the tendency is, given the corporate tax rate is at 28 cents in the dollar, that there may be a reluctance to pay a dividend. So, for example, we have your bog standard operating company, which is owned by John. You make some money, retained earnings $72. You've paid some tax, imputation credits. If OpCo pays a dividend under the current rates, if John's a 39% taxpayer, there's an additional top-up tax to pay of 11 cents in the dollar. And therein lies the potential issue. So there's a reluctance to pay a dividend, and it might be that there are good commercial reasons for doing so. You might need to invest, etc. But fundamentally, that top-up can be a deterrent to paying a dividend. So there are ways and means in this discussion document that Inland Revenue and others may find offensive, and the potential offenders are, and we'll run through them all. There is your classic, which is your classic dividend strip, which is dealt with in the legislation already in general anti-avoidance. We have a no frills scenario, and we have a hybrid scenario. And the question raised by the discussion document is which one or which ones is or are bad. As far as I can tell at the moment, the one on the right, the hybrid one, looks a little bit burnt, and perhaps we might all well be if this legislation comes into play. So the first one, the classic. This one, be very, very, very careful of this. It's a very easy trap to fall into if you're restructuring your affairs for good commercial reasons and looking for maybe a holdco model which perhaps offers a high degree or a higher degree of governance, and maybe a one-stop shop for investors where you have multiple subsidiaries. So the example here is operating company makes money, and if it pays a dividend, as we said before, then John's going to have a top-up tax to pay. What John does instead at a later date is he says, I need a better governance model. I'm going to introduce a holding company. So I'm going to sell my shares in OpCo for $100. Now that transaction ordinarily, subject to what Ian tells us later, would be a tax-free capital gain. We don't pay tax on capital gain, or do we in New Zealand? But John's sale of the shares to Holdco would be a tax-free capital gain, and he has a debt outstanding from Holdco to himself. He retains ownership or full control of Holdco and the wider group. So in terms of the offence here is OpCo pays the dividend. The dividend is now received by a Holdco, and that is exempt under New Zealand law. And then Holdco, rather than paying a dividend to John, it merely repays the debt owed to John for the shares it acquired in Holdco. And we do actually have legislation in play to for the revenue to attack this. But it's within this discussion document because they're looking to put more certainty around it. But fundamentally, you look at this type of a structure and it's really got the hallmarks of there's no change of economic control or control. It's still John at the top. Does it really have any commerciality? You can argue some commerciality in there, but maybe it's driven by tax. There's a lack of financial risk to John, and it looks a little bit artificial. So that is one of the scenarios that this discussion document is asking for people to put their views on. The second one is your no frills, and this is where you have a third party that comes into the mix. So John sells his shares to Barry. Because we've now got a change, the imputation credits have gone, but Barry's has inherited an entity with retained earnings and no imputation credits. So effectively that burden of tax in the event those imputation credits, the retained earnings are paid out to Barry, the burden of tax shifts to Barry, but John again has managed to get into a situation where fundamentally he's received a tax-free capital gain on the sale of the shares and managed to top the tax out for what he earned in the company at say 28 cents in the dollar. So that's our no frills. Our third one is a hybrid model. Not working. Sharon, are you able to, you probably can't intervene, can you? So our third one is a hybrid model of the first model. If you recall, the first one had John at the top both times. But if we look at this no frills approach, and let's say Barry, here we go, Barry decides to stick some beetroot in the middle. Barry puts his own holding company in, which then acquires the shares in Holdco. And we get back to the same situation as we had in the classic. However, we now have a change of control. It is probably more commercial, and Barry has exercised choice as to how he wants to arrange his affairs. In this situation, John still receives his tax-free capital gain, but what we've done is the retained earnings that were in OpCo at the time of the sale of the shares, they're now an absolute removal from the tax net, not just a deferral, because Barry will either repay debt or will have subscribed share capital in Holdco, such that those retained earnings can come out tax-free. It's as a concept, it can be quite hard to get your head around. However, whoever thought of it at the time, clever chap or chapess. The proposed solution is for the legislation to change such that rather than John receiving a tax-free capital gain, he may receive a mixture of capital gain and a taxable deemed dividend to the extent of the retained earnings in the operating company. So we're artificially bringing in deemed dividends to what would ordinarily be a tax-free capital receipt. There is an extra fix in there for OpCo to prevent double taxation, because of course if we tax the retained earnings and if the retained earnings still remain in operating company, when those retained earnings go out, they'll be taxed again. So those retained earnings, I believe, would switch into becoming share capital as a mitigator for the double tax. When Ian and I have been talking about this, we do actually think that, and 9 times out of 10, if we're involved in an M&A deal, we're going to look for a pre-transaction dividend anyway, which would effectively mirror the deemed dividend proposed solution. So we look to do that in any event. So there's no change there. However, we would see that more of this would be happening, perhaps more taxable bonus issues where you're effectively not dealing with cash and you switch the retained earnings out without using cash, and they become taxable dividends, share capital to the OpCo. But the big issue here is this going to be too far wider reaching? We are concerned that when working through the legislation, perhaps, and we need to get our heads around this better, but if you've already gone to that hybrid model, is there a risk that what you have done retrospectively could catch you up in the future under these new rules? I.e., could there be a burn later on? And we need to work through all of those with greater detail. And then secondly, more often than not, the classic dividend strip, well, actually all the time, there are very good commercial reasons as to why an individual or trusts or shareholders may look to interpose a holding company, governance, ease of transaction for new investors, etc. And what we would ordinarily do is we would manage that transfer such that there is no tax advantage obtained in the way that I explained it. So we are concerned that with these proposed solutions and a very much commercially driven transaction to bring in a holding company, could that cause us an issue? If in the event we may end up having to report a deemed dividend, and therefore the owner says, actually, the tax consequences means I don't want to follow through with the commerciality. But these are things to watch out for. It is a discussion document. It's proposed. Submissions closed, I said, on the 29th of April. We do not expect any legislation further to what we've heard. People might have different views until after the election next year, if at all. So that's the very first one.
Yeah, Mark, I'll just, if you can hear me, Alan, who sits on the tax advisory group with us, indicated that the revenue are actually quite keen to try and get some of this provisions into an August 22 tax bill, which would bring some of that legislation forward. So, but whether there's quite a lot of pushback, obviously, on this proposal, so it may be a watered down version to begin with. So, that which would bring it into effect probably with an August 22 bill passed in March in time for the following year.
Yeah, no, thanks, Ian. The next, oh, sorry, I should say, while we're just talking about the dividend stripping proposals, there is a further proposal to tighten record keeping. At the moment, you'll notice that financial statements refer to shareholder funds. From a tax perspective, shareholder funds is possibly made up of three component parts: your retained earnings, your capital reserves, and your share capital. Share capital and capital reserves tend to go out tax-free if you're in the right climate. Retained earnings are taxable. So there is a push to make sure that those share capital numbers and capital reserve numbers are held with adequate records in a memorandum, and possibly offer more information to the revenue. So personal services income, I recall many years ago, these were driven by IT contractors. So an IT contractor would set up a company for which that company would contract to the IT, Vodafone, whoever it might be, and they would run their personal services through the company and through to Vodafone. But by interposing the company, you get a lower tax rate. It's another deferral opportunity. So we have specific avoidance with personal services attribution rules, which seeks to overlook the legal firm and bring in what's the substance of the transaction, i.e. the person who rolled their sleeves up should be rewarded for their efforts, not the company. In this situation, the current rules are, if you have 80% or more of your income from personal services from a single customer or buyer, then the other 80% rule, where it's provided by yourself, you don't actually need any assets to run the operation, and the income is more than $70,000, then the income derived by the company, subject to a scale, is taxed in the personal services provider's name. They're looking to widen those rules and remove that first step. So the 80% or more from a single customer buyer is proposed to be removed or reduced to, say, a 50% test or maybe a 25% test. Around the peripheries is, should there be a change to the substantial business assets threshold, which currently is $75,000 or 25% of the net income of the interposed entity, I believe. So personal services is yet another move towards perhaps your general anti-avoidance and more certainty. So general anti-avoidance meaning your penny and hooper cases. But fundamentally, the golden rule here is, for tax purposes, if you roll your sleeves up and you sweat and you put some effort into it, then you should get paid for it. And there are some rules out there that are designed to do that. And I think that might be me. Yeah.
Thanks, Mark. Look, I think what's interesting about this this discussion document on selling the companies, you know, it's aimed at a situation where you've got a controlling shareholder, so somebody who's more than 50% shareholding, and that's why we sort of refer to it as selling the family company. And I think the challenge is that, despite the fact the document includes some very simplistic examples, which would indicate that the only reason you didn't pay out the dividend was because of the top up in the tax rate, it ignores the fact that in many cases you may have retained the cash to invest in the business and build the business and grow the business and still have lack of cash. And of course, under the Companies Act, as a director of a company, you've got to swear that your company and certify that your company satisfies the solvency test post a dividend statement, as a dividend being paid out. And if that just so happens to coincide with your selling the business to a third party, then there's a lot of genuine third party commercial transactions that would be caught by this, to the detriment of the vendor, where the vendor would suddenly get taxed on retained earnings that they didn't pay out during the period in which they were under that significant growth. So I think that is one of the things they'll need to get their head around. Anyway, the next stage is very quickly talk about trust compliance. And again, I'm just waiting for the slide to change over. So yeah, so in our last webinar, we talked about the new Trust Act and some of the additional obligations that were being posed on your family trusts. New Zealand has the highest number of family trusts per capita in anywhere in the world. And what has been introduced in legislation in December this year, and subsequently with followed up with an order in council, is an increased compliance requirement for many family trusts. As a starting point, all family trusts will be required to prepare minimum financial statements. All trusts, unless they're exempt, and I'll come to that exemption in a minute. The tax return will need to include an income statement, P&L account, a balance sheet, and that will probably be supplied under an IR10 form or a disclosure form within the tax return. But the financial statements must be prepared according to accrual accounting and provided to Inland Revenue if they are requested. Now, if you've been using BDO to prepare your family trust financial statements, there's not too much of an additional burden arising out of that particular piece of legislation. But there are many trusts who may have the family home in there and a little bit of interest or a little bit of dividend income, which is over the $200 threshold, and which would make it an active trust, which the trustees wouldn't have felt the need to prepare a set of financial statements just to prove the amount of income or simplistic income that the trust has derived. So there's going to be a catch up for many trusts who are in that situation, and that will increase the cost of sort of completing the tax return for that trust. The next next, if I can get the next slide to move, there we go. The additional, the order in council also includes additional disclosures that are going to be required in relation to all of those trusts. And in the first year, this year, which is the 2021 to 2022 tax return, so the year ended 31 March 2022, this tax return is going to have to complete personal information for all settlors and all appointers of a trust. Now, an appointer is a person who has the right to appoint or remove the beneficiaries or trustees, or to amend a trust deed. Now, often that will be the same person as the settlor, but you will need to go through your trust deed and double check that you get the disclosures correct. Some of the information, particularly in the first year, will be for all settlements, including historical settlements in relation to a trust. Now, that could be a real challenge. And the reason for that is that, you know, the settlor is the original person who put $10 on trust to be held for the benefit of a beneficiary. And that usually is the only settlor that we look at. But in fact, there are many situations where property can be settled onto that trust subsequently and potentially by different people, and they are not normally identified in the financial statements or on the tax returns as being an additional settlor. So there's going to be a need to go through some of that historical data and identify if there has been any sort of situations where an additional settlement has been made on the trust. And you can see here that this is it's almost like a fishing expedition where the revenue want to get more visibility on trusts and who are the people behind those trusts, with the personal information being the name, the date of birth, the tax residency, and IRD number, so that their systems can be set up to identify all of those and match all of those trusts. Hopefully, again, we will move slides. The next part of this disclosure is that annually, you're going to also have an IR6B, which is a disclosure around all distributions to beneficiaries and the value of those distributions. And you'll have to separate out whether those distributions have come from land, from income, from interest, from dividends, from different types of property. And also requiring any additional settlements that have been made during the year. So in essence, if it's a well-run trust and it's relatively simple, then it may not be that much of an onerous disclosure, but it is an additional amount of work that has to be done to get right. And this could be the tip of the iceberg. They have built into the legislation the right to go back to 2013 to 2014 to gather all of this information. So we will see if they follow through on that. Now, there are some exemptions. So a non-active trust, that is one with a family trust with just the family home in it, that has no income, or if it has income, it's interest of less than $200 from which resident withholding tax is deducted. That can be exempt from these requirements, but you need to apply for that exemption. And it will be approved, but you do need to apply. You can't rely on the revenue being aware that you haven't got that level. There's foreign trust with New Zealand resident trustees. There's a separate disclosure regime that applies to them, and the Maori authorities and charitable trusts are obviously exempt. So where are the risk factors in this? Where are the problems? Well, look, as I say, if you're preparing financial statements, most cash settlements and cash distributions will be included in the financial statement. So it'll be relatively easy to comply or identify that, or there might be some more detail than you'd normally have to gather, more information you have to gather. And so that's fine. What the risk areas that we see are going to be things like non-cash settlements or non-cash distributions. And this is a non-cash settlement could be you providing funds or a loan to a trust at a lower interest rate than market value. That could be an additional settlement if somebody has lent that money to it. And think of maybe you've got a beneficiary who you owe more than $25,000 to. The trust owes more than $25,000. Now, how that would happen would be that you've gone around your tax return, you've done your financial statements, and you've allocated out $60,000 or $70,000 of income to a beneficiary. That beneficiary, but you don't pay the beneficiary that cash. If that's the case, then you need to charge interest on that amount owed, or the beneficiary needs to charge interest on that amount owed. Otherwise, it's a non-cash settlement and needs to be disclosed in these new disclosure rules. The second area is on a non-cash distribution. Sorry, if I just stay with that settlement, that could have an impact on bringing a beneficiary. So might be one of your children or a dependent who into being deemed to be a settlor, which has implications for associated persons of the trust. If they're on a benefit where they're getting working for families or certain entitlements, it may have an impact on their right to that. The other area is non-cash distributions. Now, one of the simple examples I used in the operational statement that came out in April this year is the use of a property for no consideration. So you've got ABC Trust, and it lends it has a property that allows one of its beneficiaries to live in that property for no consideration. In that situation, that's a distribution that needs to be disclosed. Now, there's two rules here that it can be disclosed as having a nil value, and you just tick the box that has use of property for no consideration, or you can identify the value of the rent-free benefit to that beneficiary and tick the box but put a $sign in there. To me, it seems like a lot of extra work for not much. And I'm begging myself, do I need to determine if a trust that has a holiday home by the sea that your kids go and use for anniversary weekend, do you need to tick the box that they've used that for no benefit and no beneficiary, and that's somehow a non-cash distribution? So that might settle down over time. It seems like a big reach, but the IRD are clearly wanting to bring that in to get more information and find out what's happening behind these trusts. Ironically, this is going to add to the cost of compliance of these trusts. And ironically, that will then mean it's still the people who can afford to run the trusts to be able to administer them properly, as opposed to other people who may be just using it as an asset protection vehicle, but maybe aren't administering it as well as they should be. And I think there'll be a continuing message that those trusts are only available to those who can afford to use them. So I don't think that's really necessarily a good thing. So lots of watch this space on the trusts, and unfortunately your 2021-22 financial statements and tax returns is going to be a lot more work required to get them completed to the satisfaction of the revenue. So if I move to the next slide, it's just come up. Slight change of topic. I got to present to the CANS Chartered Accountants tax conference at the end of last year on the topic of, is the rise of sharesies and online trading platforms going to cause a tax problem? The rise of an accidental income, accidental share traders coming out of that. We were going to talk about when's a capital gain, not a capital gain, both through online trading, cryptocurrencies and residential properties. We feel that given the time we've got available, the residential properties we've dealt with in prior seminars. The 10-year bright line rule makes life very difficult on selling those properties. There's accidental situations where if you move from one trust to another, and that will trigger a bright line. The 10-year rule needs to be worked through quite carefully, obviously. So having been charged with the task of talking about online share trading, I did a bit of research on what those shares look like, and there's been an increasing number of share trading platforms. Sharesies is probably the one that's been the most public, but there's quite a lot of ones available to people to get in on the market. Now, this was a very deliberate policy of NZX. They did a process. I reached out to NZX and they gave me some information. They said in 2015 they developed a strategy to make it as much on-market trading as possible. They then ran a trial in 2017 which proved to be really successful, and introduced and revised their rules, and importantly reduced the number of fees that were involved in allowing on-market trading within in 2018. And that's when the likes of Sharesies came on board. And it's been a success. The volume of trades has increased substantially. The average trade price is 5 times smaller, but there's increasing frequency. And this is the data they got from NZX. You can see that here the average trade is dropped right down to a much lower level. So it's almost 5 times smaller than it was in 2015, but there has been increased frequency of trading, and the trade value has also gone up. You can see here there's two lines. The bottom line is the retail trading and the top line is the wholesale. So you can see here that over time, the wholesale percentage of the trading market has dropped to under 85%, and the retail trading has gone up to about 17-18% from just over 10. So there has been good growth in that area. So is this I guess the reason we're showing this is we need to work out if this online share trading is a problem for the IRD, and is the increased volume and increased growth likely to cause a problem? So, well, there's no need specifically at this stage for any changes in legislation. We've got plenty of taxing provisions that can capture people who are buying and selling property, personal property. Now, we're going to talk about it in the context of shares, and Mark will talk about it in the context of cryptocurrency, but these are profit-making undertaking. This is about personal property, not real property, and as a consequence, it can apply to antiques, it can apply to art, it can apply to fine wine, and it can apply to rare whiskey. And as some of you may know, I have a wee penchant for whiskey. Anyway, there are 3 provisions that I'll go through. And the first one I want to go through is CB4, which is the one that's the most common section that you need to look at. And that is, did you buy the shares with the purpose of disposing of those shares? Now, I apologize for the amount of words on this particular slide, but the slides are saved and the session is being recorded, so it will be made available on our website, and you can take your time to look through here. But Sir Ivor Richardson was one of the clearest thinking judges that we had, and in the National Distributor case, he set out 9 tests which absolutely need to be referred to on a regular basis when looking at this question. So first of all, it's a subjective test. It goes to the state of mind of the purchaser at the time they acquire the property. So we know it's difficult to prove what the state of mind is, but that is the test. Importantly, if there's more than one purpose, the test has to be the dominant purpose. The test of resale has to be the dominant purpose. Now, that's quite different to land transaction rules. When we've talked about land transactions, it just needs to be one of a number of purposes that you had of selling the property. Motive, intention, and purpose are distinguishable. In CB4, it is purpose that is the only driver. So if there's a purpose of resale, it's irrelevant that the sale is a means to an end. The nature of the asset is an important consideration. How long you hold it is important as well. So it's a balance of all those factors. Lastly, I think I'll just go to point 8. If your sales are made in course of reviewing an investment portfolio held for its potential income yield, this is like rebalancing your share portfolio. It's arguable that they are different from sales of shares which were purchased with the primary aim of selling. So in that case, a rebalancing your portfolio may not be enough to mean that you bought that particular parcel of shares with the purpose of disposal. The next area is CB5. So is the activity you're doing online share trading enough to constitute a business of dealing in personal property? And again, there's some good case law in this one. To sum this down, the key one is the Rangatira decision. It was one where you had a large investment company that had a big portfolio that bought and sold shares from time to time. The level of activity had increased by some time, so the revenue turned around and said, we think you're now a share trader. The chairman gave good evidence to the courts and said, look, apart from 3 parcels that we bought clearly for resale, the rest were just part of normal realization of capital assets. And the courts went through that process and said it did not reflect a change in the nature of their business. So I want to take you to, in considering whether you're a share trader and in the business of dealing in personal property, there are 2 really helpful cases in Inglis and Stockwell, which for those of you old enough to remember the 87 stock market crash, where a lot of people were in the stock market, these were cases involving claiming tax losses. And the structure of our tax act at that time made it unclear as to whether you could get a deduction for losses. Anyway, the decisions and the judgments in in Stockwell, because Stockwell they had assessed it as being taxable, and then sorry, as being in the trading, and then allowed losses. These are some really clear things here. Cook said one should be slow to find that the taxpayer has embarked upon a business. This is where they have a full-time occupation but devotes some of his spare time to stock exchange speculation. So you should be slow to deem you to be in the business of buying and selling of being in business of dealing in property. Hardy Boy says where a particular activity amounts to business is a matter of fact and degree. The continuity and extent of the activity is important consideration, if not the dominant considerations. An activity need not be the taxpayer's sole or even principal activity. And he goes on to later say there would have to be a substantial capital investment and a significant commitment for it to be regarded as a business of dealing in shares. So I think if you're buying and selling online share trading, I don't see you being held quickly to be in the business of dealing in shares. So CB5 shouldn't apply, and you should focus on CB4, which was, did I buy that individual parcel of shares with the purpose of resale? Section CB3 cannot, however, be ignored, but it's the one to catch any residual transactions that are not otherwise taxed by CB4 or CB5, but it must involve an undertaking or scheme for profit, a plan of action, or an enterprise where the dominant purpose is to make a profit and to produce income, not a capital gain. So I think that one has, although it's a catch-all, it takes a little bit to create the fact that you're on a hobby just trading on shares online to turn that into an undertaking or scheme. So has the rise of sharesies and the sort of trading platforms changed the landscape? Arguably not, but it might depend on whether it continues to grow and become a problem that the revenue think they need to deal with. You know, it's easier for taxpayers to have greater access to markets. We know how difficult it is for them to document their intention or purpose at the time of acquisition. And while case law has, you know, the traditional capital revenue, the bar might be a wee bit lower than we think. A question whether you need to set up a different entity to say whether I need trading. These are shares that I'm trading in for speculation, and these are shares that I hold for long-term hold. The case law on personal property is quite clear. You don't need to set up different entities. There is no tainting unless you got to the level where it was a business of dealing in personal property. But if you're still under CB4, the fact that you buy some shares and sell them doesn't taint others that you've held for long-term hold. The focus has to be on the individual parcel of shares. And lastly, just to reflect that New Zealand and Australian shares, which are caught by these rules, are treated differently from other offshore shares, which are foreign investment funds and subject to the fair dividend rate. So they give you a completely different outcome as well. So if you're in the business of if you are participating through those online share trading platforms, be good to document your intention each time you go and buy those shares, and make sure that you're not in the business of dealing in shares, or you did not, or the ones that you bought with the intention of resale, you return under the self-assessment regime. Now, these principles apply equally to cryptocurrency, and I'll pass this over to Mark for the next part on cryptos.
And I don't expect the answer to this, but while I'm doing this, I heard you mention Hardy Boys just then, and I've always wondered if the Hardy Boys were named after Hardy Boys or if it was the other way around, but that's for another day. And I still can't get this to work. Okay, crypto. I could start with saying what he said. So crypto does quite definitely, everything Ian has just said is very, very relevant to the world of crypto, if I can get to it. Here we go. The first thing to work out with crypto, and we're talking about crypto assets here, not just cryptocurrency. Cryptocurrency is one of the crypto assets, but from certainly from Inland Revenue's perspective, it's not currency, it's property. And that's why everything Ian has mentioned is very, very relevant, because we do have rules already in our tax legislation that deal with property. If I go, okay, we're going to go.
I think Sharon still has control of it.
Things with crypto is know what you're dealing with, because to work out whether, say, you've bought something for the purpose of resale, then I'm going to say, how does an airdrop? How is an airdrop being acquired for the purpose of resale? Because an airdrop is something you got for free. It's normally used to increase awareness of a particular crypto asset. It's maybe something to give to an investor early, and it increases the supply. But what was in your head at the time you acquired that first crypto, the crypto asset that gave rise to the airdrop, or did you just get an airdrop for no good reason? It's almost a little bit like an inheritance. But while you might not have acquired an airdrop for the purpose of disposal, you may have an underlying plan or series of transactions or steps where you are looking and putting yourself in a position to get airdrops. So that's airdrops, staking. Oh, sorry, I need to backstep a bit. Inland revenue, when crypto first came out, very much of the view that if it moved, we're going to tax it. So anything to do with crypto, if you made a profit on it, is taxable. This view has very much changed because you can do more with crypto now. It's not just cryptocurrencies. And like I said, we've now got this concept of airdrops. We've also got a concept of staking. So your cryptocurrency, you can effectively stake it or lend it in return for a fee or something akin to a rate to an interest, So I haven't necessarily just bought my crypto for the purposes of sale or for the purpose of resale. I actually bought it for the purpose of deriving long-term staking income. While the staking income might be taxable, the actual crypto asset itself is arguably outside of the tax net. Hard forks and soft forks, possibly a bit of a fancy name for something. It does look a bit complicated. A hard fork is where you've got a split in the blockchain, but it's more easily explained if you think about you've got two versions of something. So you had a Bitcoin, and you've now got Bitcoin Cash running alongside Bitcoin. So it's a split in the chain where you end up having two versions. You've got the old Bitcoin and the new Bitcoin Cash running alongside each other. And so the question is, if I sell the new Bitcoin I received, is that taxable? And it possibly would be if you bought the old for the purpose of sale. So we're still looking into what was in your mind. Did you buy it for the purpose of? And they're interlinked. The soft fork is where one, you've still got an amended protocol, if you like, or a new blockchain, but you don't have two running alongside each other. There is no new coin, so the existing adopts all the new. And again, the question is, even though we've got this new crypto, did I acquire for the purpose of resale? Do I have a profit-making undertaking scheme? Do I have a business? NFTs, I love these because we saw one recently, and it was the increase in value was phenomenal. This is a picture of the Bored Ape Yacht Club. And the NFT, or a non-fungible token, is something normally a reference to a digital file. So it's a photo, it's a video, it's some audio, but it's unique. It's uniquely identifiable. It's one of a kind. Now, with an NFT, from what we've seen, you might well be a collector of NFTs. It's something you do as a hobby, much akin to perhaps a basketball card, or the Michael Jordan, or whatever else that might be. But what was your motive? And if your motive is it's part of your hobby and this is what you're interested in, then perhaps even though you may have held a non-fungible token for a small amount of time, perhaps the circumstances stack up such that you did not acquire for the purpose of resale. So with crypto, it's understanding what you're dealing with and getting into these concepts. I'd expect these rules are all subjective. I've just realised that picture. That's a good one. We don't tend to shout at the inland revenue. It doesn't work. they tend to hold the power. But what we might expect is a dispute with Inland Revenue. So Inland Revenue's view might be the circumstances, or prove to me that you didn't acquire for the purpose of resale. The onus of proof, the burden of proof shifts to you. We're also thinking that perhaps, as we've seen with land, could there be, or with shares, foreign shares, could we introduce a bright line type rule that if you hold crypto for a short period of time, I don't care why you bought it, how you sold it, we're going to tax it. Or an FDR rule, which maybe deems some income over the period. We've also seen overseas with crypto, given it's a taxation on realization of the property, that perhaps we might have some anti-avoidance legislation that could creep into the mix, such as a bed and breakfast rule. Now, what we mean by this is at the end of the year, let's suppose your crypto asset has dropped in value and you would have a taxable loss. You won't be able to claim that taxable loss unless you crystallize it. But you might not want to get out of that asset in itself. So you crystallize the loss on the 31st of March, i.e. you sell it, and then you buy it back again on the 1st of April. The beauty of that is we can use the loss and accelerate the use of that loss for the tax year up to the 31st of March, but we haven't actually divested. So a bed and breakfast rule would ignore again the form of the transaction, i.e. you sold and bought, and would, for tax purposes, deem you to have held that investment throughout. So these are the things that we think we might see as crypto evolves and we all get our heads around it. So I'll move on to our budget 22, the wish list. I think Ian mentioned up front, we're not expecting any whiz-bang massive announcements for tax. At the moment, tax seems to happen throughout the year in terms of proposals, legislative change, etc. But what we would like to see is a move back, or what we see is at the moment perhaps a departure from a consultative process, which is the generic tax policy process, where all parties are involved throughout the process of establishing and determining what could be good tax legislation. The feeling, certainly, and I'll speak for myself as opposed to every single person at BDO, of course, but the feeling is perhaps that policy is almost agreed and written before persons have had a chance to really put their views across. So we'd like to see more thinking together. Simplicity is the ultimate sophistication. The tax legislation is becoming more and more complicated, and I think a lot of the complications are coming in because the view is that the taxpayer is naughty as a default, which means we need a lot more anti-avoidance legislation, such as those dividend stripping rules we just talked about. Whereas in fact, there might be some taxpayers out there, goodness gracious me, who are actually doing things for good, honest commercial reasons. So some of these things coming in can be quite a blunt tool. We would like to see, with the age of digitisation, that there could be more thresholds, higher thresholds, more safe harbour benchmarks, which is moving towards close enough is good enough. The depreciation regime, trying to work your way through the minefield of working out, am I depreciating this particular asset which doesn't yet exist at either 15% DV or 12% straight line, is very readily, very easy to make mistakes, and it sucks up a whole heap of time. And like I said, increasing automation, which is what they're doing as well, simplicity in that regard. We'd also like to see more support for businesses. We've got a very, very low value asset write-off. It's gone back down to $1,000. Other countries way exceeds this. Ian's one, which I agree with. We'd like to have more better measures for that working from home environment as we adapt further in how we do business. And please bring back the 1-year carryback for losses permanently. Give us something to do in the tax team that offers a good story. So that's our budget wish list. Ian, have you got anything to add to that?
No, I think look, it's it's one of these things where it's hard to bring them a wish list knowing that they're not going to put anything in this particular budget anyway. So we don't have high expectations of any changes. I think the some of those support business measures, you know, they've been quick to support them in times of difficulty because of the COVID, and some of those reliefs that were introduced, I think, could become permanent, and I think that would make life a lot simpler. And particularly those safe harbour ones would be a hell of a lot easier for smaller businesses that are going out to start expand overseas and just be able to comply with tax transfer pricing requirements in these jurisdictions. So the revenue's got the ones with the biggest amount of data possible. They should make that available to say, hey, margins within this region, this area are acceptable if that's the type of business you're in. So we'll go. Anyway, we've got a couple of questions. If you go to the next slide, please. This is one of my favourite pictures of all time. That was the Idabun Dam down in central Otago, where I once played in the National Bonspiel for curling. And I've just come back from Europe, where I was playing for New Zealand at the World Seniors curling competition. But we talk about throwing rocks, so I think it's always a good slide for throwing questions at us. And we've had a couple. The first one is that I mentioned at the IRD on the trust compliance was that IRD can go back to 2013-14 for information and trusts, and is that just to gather information or to retrospectively apply these rules? Well, the rules are really just about financial statements and financial information and additional disclosures. So the fact that they've deliberately asked that they've got the right to go back to 2013, 2014. You have to retain records for 7 years. Now, with a lot of trust records, you need to keep them for 120 years, your forgiveness of debts and that type of thing. So one would assume that if the revenue are going to request that additional 7 years, then they've seen something in the trust that they want to go and have a look at. Whether they could then impose other aspects of the tax if they feel that Tax Act, if they feel that the trusts have been misused in a particular way, I don't know. It's hard to. 7 years would is the record keeping requirement. Statute bar on tax is usually 4 years, but I think the message is if you're doing a bit of work on your first year to identify all your historical settlements, and that may be worthwhile making sure that the records are around if you need to provide additional financial information, that if the revenue come calling for it, that you've got it at hand. It's almost like tidying the house up for cleaning. So have we got any more questions?
There's a comment from Fiona around crypto asset profits not being there for a while, which we can't give financial advice, but we do see that they've taken a hit. One of the things you should be thinking about is whether or not you do have the ability to claim any losses that are arising from your divestments in crypto, if that's what's happened. Now, Ian, I think because we've had to go half an hour later, we're a bit like Cinderella here, where we're going to lose the glass slipper at 10:30 on the dot. So okay, maybe I'll pass to you for the close.
Yeah, there's one last question, which I think is quite an important one, which implication of selling shares in a closely held family company, which invests in residential rental property to a family trust. I think you've got to be very careful, because I think there are bright line rules in there that selling of the shares in a residential rental property can be caught by those bright lines. So take specific advice on that.
Yeah,
to be careful
with I think they refer to land-rich companies.
Land-rich companies, exactly.
Anti-avoidance measures to stop you from stepping around bright line by selling shares. So that's 100% right. Yeah.
So look, thank you everybody. If you can just go to the last slide. Thanks everybody for your patience and in joining the call afterwards. We will, as I say, it is recorded, and we will be on the we will be recording, make it available on the website. watch out for a budget commentary on next Thursday. Although it may not include much by way of tax, it may include some interesting facts on the economy and how we're faring, and also with inflation growing in the economy and some of the challenges around it. They've made it perfectly clear it's going to be about housing, health and climate change, and we've got a panel of experts from our wider BDO partnership willing to comment on that day, so look out for that. Thank you again for attending, and yeah, enjoy the rest of your day.
See you, Tim.
Thanks, Mark. Oh, and thanks to Sharon and Jamie for the support behind the scenes.